Everyone's investing these days. Your friends, your parents, and even the neighborhood shop owner. So what changed? For years, the Indian middle class believed the stock market was too risky and it's better to stay away. Is that belief changing? And how is the stock market is seeing that change? We analyzed the market and it was shocking to us. In the last year, while the Nifty 50 returned just 11%, the Nifty Next 50 even 0.56%. The Nifty Mid Small Financial Services Index is up 30%. Nifty Financial Services X Bank is up 28%, and Nifty Capital Markets 16%. How are these capital market indices able to give 20% higher returns as compared to the Nifty 50? In the last 5 years, the Demat accounts have risen from 4 crores in FY20 to more than 21 crores in November 2025, showing how many more Indians are directly plugged into the capital markets. Is it only an account increase or did the money also flow on it? In the last 2 years, several fund houses have seen their AUMs multiply 5 to 8 times. Even players like Motilal Oswal, Quant Mutual Fund and Parag Parekh have doubled or tripled their asset base. India's capital market ecosystem isn't just mutual funds. There are many players in it. Who are all these players and who actually makes money in which scenario? So in this video, we will do 3 things. Map every player in the capital market ecosystem, explain their role in simple terms, what they actually do and how they earn, rank them at the end which player is best depending on the scenario. And yes, watch till the end because the best player is not the one you think is. Let's start with the big macro picture. What is the big tailwind driving all this? Indian households set aside a significant portion of their income as saving rather than spending it on consumption. But what's really new here? As Indians, we have always been known for our saving habits. We have seen it in our homes too, where savings has always been our first priority. So what has changed now? The way we save has changed. Shares, which used to have just 0.2% of the GDP in FY15, is now 1% of the GDP. A 5 times rise. Households are no longer keeping money idle in FDs or jewelry. They are moving it into products such as mutual funds, PMS, AIFs and insurance. Along with this, the Demat accounts have also risen from 4 crores in FY20 to 21 crores. That's a 5x jump in just over 5 years. Same with the SIP, with more than 10 crore accounts contributing to 30,000 crore rupees per month. This reflects the consistent retail participation in mutual funds. We have rising AUMs, record SIP inflows and crores of new Demat accounts, but still a long way to go. Our mutual fund assets stand at just 19.9% of the GDP, while developed markets such as the US having 124% and the UK having 59% are far ahead. That means India's growing participation is still in its early innings. Despite rapid growth, mutual fund penetration remains low relative to income and saving potential. In the last few years, the shift of domestic saving to capital markets has picked up sharply. Bank deposits and idle cash are increasingly flowing into market-linked products. So who is actually benefiting from this? The answer is ecosystem. Yes, the whole capital market ecosystem. Let's understand what this ecosystem means. At its core, the capital market is very simple. There are 2 sides, people who have capital and people who need capital. Everything else you hear like exchanges, brokers, depositories exist only to connect these 2 smoothly and safely. First comes the investors, the capital providers. These are the people and institutions who have savings and want them to grow. Their question is simple: where should I put my money? Second is companies and government. Capital seeker. These are businesses and governments that need money. Their question is also simple: how do I raise money? Now comes the capital market, the meeting ground. But investors and companies don't meet directly. They meet through a system of specialized players. These specialized players are stock exchange brokers and investment bankers, depositories, asset management companies, wealth managers, RTAs, custodians, and B2B2C distributors. Each player has one clear job. Let's understand that. Putting it all together, when a company raises money, it goes to an investment banker who helps the company get listed on the stock exchange. An investor goes to a broker who provides access to the stock exchange. Once the company and the investor reach the stock exchange, transactions take place. And records of these transactions are maintained by the registrar and transfer agent. The shares purchased by the investor are then stored with the depository for safekeeping. There are also support players such as wealth managers, custodian, and B2B2C distributors. This makes up the entire ecosystem. Now that we have understood this, let's break down each participant in the ecosystem. Not everyone can invest in the stock market directly. Most people do not have the time, expertise, or emotional discipline to analyze companies, trace markets, rebalance portfolios, and manage risk across cycles. This is where professional money managers come in. These professionals manage your money on your behalf. They decide where to invest, how much to allocate, when to rebalance, and how to manage risk. And in return, they charge you a fixed fee, irrespective of whether markets go up or down or move sideways. That professional manager's team is called an asset management company or an AMC. AMCs are the company behind your mutual funds or PMS and AIF. So when you are investing in, say, a HDFC mutual fund, then HDFC AMC would be managing your funds. Let's understand the business model of an AMC. An AMC does not earn based on profits that made for client. It earns a management fee on the total money it manages. This fee is charged through something called an expense ratio. So when we talk about AMC revenue, we are not talking about stock market gains. We are talking about fees earned on assets under management or AUM. Why AUM mix matters more than AUM size? Because all AUM does not earn the same fee. Funds invested in equities generally carry higher fees. Debt and liquid categories carry lower fees. Passive and ETF products have the lowest fees. So, two AMCs can manage similar amount of money but earn very different revenues. The difference comes from where that money is invested. That is why AUM mix matters more than just total AUM numbers. Across all Indian AMCs, revenue typically works out to roughly 0.35% to 0.55% of the AUM annually. That may sound small, but remember the scale. India's mutual fund industry today manages close to 80 lakh crore rupees. So even a fraction of a percent becomes massive recurring revenue stream. And this revenue grows when AUM grows. AUM grows with two reasons, like one, with more inflows, and second, just a rally in the markets. Now let's understand the cost structure, why AMCs are asset light. Now let's talk about cost. AMCs are asset light businesses. They do not need factories, inventory, or heavy capital expenditure. Their major costs are employee salary and fund managers, distribution and commission payouts, technology and compliance, branding and marketing. As AMC reaches scale, most incremental revenue does not need proportional cost increases. That creates strong operating leverage. Because of this structure, AMCs enjoy high profit margins, strong return on equity, consistent cash generation. They do not take direct market risk. They monetize participation in the market, not market direction. As long as money stays invested, the fee continues. That is the structural strength of this business. The key strengths are recurring fee-based revenue. Market rally will increase the AUM without fresh inflows. Asset light and scalable structure. Strong operating leverage. SIP-driven visibility. Direct beneficiary of financialization. But this is not a risk-free business. Key risks include regulatory cap on expense ratios, like once a scheme crosses certain threshold for AUM, the expense ratios have to be lowered as per regulations. The SEBI recently only came with regulations to further reduce the TERs. Rising share of low-fee passive products gaining popularity. Intense competition for inflows. Hence, AMCs must constantly innovate, build trust, and improve distribution efficiency to overcome these challenges. India is still early in its financialization journey. Household savings are steadily moving from physical assets to financial assets. As more investors enter market through SIPs, the role of professional money managers only becomes stronger. This gives AMCs a long runway for growth, even across volatile market cycles. On the listed side, the major AMCs include HDFC AMC, ICICI Prudential AMC, Nippon Life India AMC, Aditya Birla Sun Life AMC, and UTI AMC. But here is the interesting twist. The largest AMC in India by AUM is not listed as a standalone company. That is SBI Mutual Fund, which is in talks to come for an IPO in future. We will discuss in great detail about the listed players in another video, but for now, let's come to another piece of this ecosystem. How do we invest in mutual funds? There are two ways. First is direct, that is investing through fintech apps or directly on the website of a mutual fund. Second is via distributors. Most of the money still flows through the distributors. Now, it is practically not possible for every distributor to have access to guidance and technology at a cheap rate while starting their business, as the trail commission income is quite low initially. That is where the B2B2C distributors help the smaller distributors. These channels are the infrastructure that powers distribution at scale. They enable thousands of mutual fund distributors with technology platforms, transaction processing, commission and trail management, product access, and support system. AMC creates and manages the scheme. Distributors enable the distribution to end investor. Key revenue drivers include trail commissions from AMCs, which is the main source of revenue, cross-selling insurance, bonds, portfolio management services, etc. Key cost drivers. Their main cost is the revenue sharing that they do with the distributor on their platform. For example, if they get 0.5% of the AUM in a particular scheme, they would pass on 0.4%. India has two such big players, NJ Invest and Prudent Corporate Advisory Services, out of which only Prudent is listed. It benefits as long as mutual fund penetration rises. RTAs are the quiet infrastructure layer behind mutual funds and other issuer services. They sit between investors, AMCs, and distributors, ensuring that every folio, transaction, SIP instruction, redemption, payout, regulatory report is processed accurately and on time. Their revenue is linked to volumes and assets serviced across categories like mutual funds, AIF services. Revenue drivers for them are fee from AMCs. They receive a small percentage of equity AUM as trail fee. Volume growth, more investors, more SIP. They are also diversifying into other services and products like payments, insurance repositories, KYC, etc., giving additional sources of income. Cost drivers, their main cost is investment in tech and employee cost. This entire layer is a scale and operating leverage story. Once the platform, compliance stack, connectivity, and processes are in place, costs do not rise in the same proportion as new accounts, new folios, new SIPs, new IPO allotment, or higher trading activity. That means each additional unit of activity can add incremental, high margin revenue over time. Key listed examples include CAMS and KFin Technologies. Now let's understand the business of a wealth manager. At a high level, wealth management looks similar to asset management. Both deal with client assets, but the economic engine is very different. Here, the core driver is client relationship, not scale alone. A wealth manager manages money at the client level, not at the scheme level. The primary revenue stream in wealth management are, first, the trail income and transaction fee. In addition to advisory fees, wealth managers earn trail commissions from products they distribute, such as mutual funds, PMS, and AIFs, insurance, or structured products. Trail income is recurring in nature and grows as long as the client stays invested. Second is planning and one-time fees. Some wealth managers also charge financial planning fees, estate or succession planning fees, specialized advisory or restructuring fees. For many wealth managers, revenue doesn't come only from advisory fees. A large part of the business is built around an integrated ecosystem. These firms often operate their own investment advisory arms, broking platforms, and even asset management companies. This allows them to cross-sell products to the same client base. Key revenue drivers include the biggest driver is the asset under advisory or asset under management within the wealth platform. More client assets means more trail income and more opportunity for cross-sell. The second driver is client mix. HNI and ultra HNI clients typically generate higher revenue per client because they use more products and need deeper advisory support. The third driver is market activity and sentiment. In bullish cycles, transaction income and product sales tend to rise. In muted cycles, trail income becomes the stability anchor. Cost structure. Wealth management is not capital heavy, but it is people and platform heavy. The major cost components typically include relationship managers and leadership teams, research and investment advisory support, and distribution and client acquisition costs. Key risks and pressure points. The first risk is competition from digital platforms and low-cost alternatives, which can pull mass affluent clients towards commoditized advice. The second risk is market cycles. During risk-off phases, clients may reduce activity. The long-term opportunity remains strong because India's affluent base is expanding. Financial assets are growing, and more families need structured advice around goals, succession, and diversification. As wealth shifts from informal advice to formal platforms, wealth managers can deepen wallet share and increase client lifetime value through recurring engagement. Listed players in wealth management. On the listed side, prominent names in this space include Nuvama Wealth, Anand Rathi Wealth, and 361 Wealth. Let's move to the next layers of the capital market ecosystem. There are three broad types of brokers. First are discount brokers. These are platform-led, low-cost brokers that focus on scale and user experience. Examples include Zerodha, Grow, Angel One, and Upstocks. Second are full-service brokers. These are relationship-led brokers that offer a wider bouquet like research, advisory, portfolio guidance, and sometimes offline support. Examples include ICICI Securities, Motilal Oswal, etc. Third are hybrid or new age full stack brokers. These combine the low-cost digital platform approach with add-on products like wealth, lending, distribution, and premium tools. Now let's get into the business model. At the core, brokers provide the rails that allow retail investors to buy and sell shares, trade derivatives, invest in mutual funds, and ETFs. Apply for IPOs, access margin funding, and increasingly use research and tools through the same platform. The broker is basically the gateway to capital markets. Stockbroking revenue comes from three primary channels. First is brokerage and transaction linked income. Every time a client places a trade, the broker earns a fee. This is not asset driven income, this is volume driven income. Second is margin funding and interest income. Brokers earn interest by funding client position, especially when clients use leverage. But this stream is sensitive to regulation. Third is subscriptions and premium tools. This is an emerging revenue stream. It includes premium analytics, advanced trading tools, research dashboards, and value-added services. A fourth layer also exists for some brokers through cross-sell. Key revenue drivers. The biggest driver is active users and trading activity. A broker is only as good as how many users it can activate, retain, and increase engagement for. The second driver is product mix. A platform with higher derivative participation will see higher volume-led earnings, but also higher cyclicality. Cost structure. Stockbroking is a platform business, but it has serious fixed costs. Key cost components include technology and product development, customer acquisition and marketing, customer support and servicing, risk management and compliance. People costs, especially in research and advisory for full service firms, this is where the business splits. Discount brokers focus on low servicing cost per user and high scale. Full service brokers carry higher people and advisory costs, but aim for higher revenue per client. Once a broker reaches scale, fixed costs spread out. That creates operating leverage, but only if the platform keeps activity and retention strong. The biggest strength is distribution control. Brokers own the customer interface. They are the gateway. As more Indians enter markets, brokers are the first platform they touch. Second, digital broking has near zero marginal cost scalability. Once the platform is built, adding new users is far cheaper than traditional relationship-led expansion. Obviously, to handle more customers efficiently, more needs to be spent on technology. Third, brokers have a natural path to expand into adjacent products like wealth, lending, and distribution, which can improve revenue quality over time. Weaknesses. The biggest weakness is transaction dependence. When trading activity slows, revenue can fall quickly. Competition has pushed brokerage yields down across the industry, especially for retail. Third, for many brokers, a high share of revenue can be linked to derivatives volume, which can make earnings more cyclical. The biggest opportunity is cross-selling. A broking relationship is the starting point, not the end point. Brokers can expand into wealth management and advisory, distribution of mutual funds and other products, margin funding and lending solutions, premium tools and subscriptions. The brokers that successfully move beyond pure broking can shift from volume-driven income to relationship-driven income, which is structurally stronger. Threats. The key threat is regulatory tightening, especially around leverage and derivatives. If rules restrict participation, reduce leverage, or raise compliance burden, the immediate impact is lower derivative volumes, lower margin funding income, more pressure on transaction-driven earnings. Third threat is platform competition, where switching cost can be low for pure trading users, especially if pricing and experience are similar. Now we come to the most underrated player of this ecosystem. These are the rails that make the systems work at scale, with trust and without chaos. Two players sit here: stock exchanges, depositories. And the reason this layers matters is simple. Demat accounts have crossed 21 crores, with CDSL alone holding over 17 crore live accounts. NSE and BSE are handling record daily turnovers. IPO fundraising in FY25 alone touched 1.7 lakh crores, one of the highest ever. Every one of these actions create fee income for the market enablers. What stock exchanges do, exchanges are marketplaces. Whenever you place an order on your broker, it gets routed through the exchange. They provide the platform where trades happen, prices are discovered, and liquidity is created. Let's understand the business model. Exchange revenue typically comes from these buckets. First, transaction charges. Second, listing and issuer services. Third, clearing and settlement ecosystem economics. Revenue drivers. 1. Market activity and participation. More investors, more trades, more turnover. Hence, transaction-linked income moves up. 2. Product mix derivatives. Hence, heavy activity can lift revenues but also increases cyclicality and regulatory sensitivity. Third, listing cycle. A strong IPO pipeline and steady listed base supports listed linked revenue. Cost structure. They are capex and compliance heavy. Key costs include technology infrastructure, cybersecurity, surveillance, risk systems, regulatory compliance, and large-scale data distribution. Now, the second enabler, the depositories. Depositories are the backbone of Demat ownership. They record who owns what, enable transfer of securities, and handle pledges, corporate actions, and the entire post-trade ownership system. Let's understand the business model. Depository revenue is structurally attractive because it has a strong annuity component. First, annual and custody fee. Recurring base. A major part of depository economics comes from annual fees charged to DPs and annual custody issuer-linked fees, which are more stable than pure transaction income. Second, transaction fees. Every Demat account, settlement-related transaction, and servicing flow creates transaction-linked income. But this is typically a second layer on the top of a recurring base. Key revenue drivers. 1. Growth in Demat accounts and financialization. More accounts and more assets in Demat expands the base for recurring fees and service usage. 2. Corporate actions and market issuance cycles. IPOs, buybacks, splits, dividends, and other corporate actions increase servicing intensity. Cost structure. Depositories run on technology resilience, information security, regulatory compliance, operation and issuer DP servicing. The key point is cost base is stable, while the revenue base can expand steadily with ecosystem growth. which creates a high quality operating leverage profile over time. The two depositories are CDSL and NSDL, and CDSL has the larger share of investor accounts. Custodian is the institution that holds and safeguards security on behalf of the investors. They handle things like safekeeping of securities, settlement support, corporate actions, reporting, and operational execution for institutional flows. Also, there are no listed custodians businesses in India. Another key player is investment bankers. They work behind the scenes to help companies raise capital, execute large transactions like IPOs, and follow on issues to fundraisers, mergers, and acquisitions. Their income is largely deal driven. One listed name in this space is DAM Capital Advisors Limited. While all the above subsectors are in the capital market space, their different business models can lead to very different financial outcomes for the company and you as an investor. Hence, selecting the right subsector becomes extremely important. From AMCs, distributor, RTAs, and wealth managers, revenue is largely AUM linked. That means income is more visible because it's tied to long-term client assets such as fees, trails, and advisory annuities. From brokers, exchanges, and depositories, revenues becomes far more transaction or volume linked. Here, activity matters. Turnover, volatility, participation, and event cycles drive earnings. The common link across the ecosystem is this: operating leverage is medium to high for almost everyone. Once these platforms reach scale, incremental revenue doesn't require proportional costs. The pipes are already built. Scalability also ranges from medium to very high. Utility-like players such as AMCs, RTAs, exchanges, and depositories scale exceptionally well because the same infrastructure can serve millions of users. Entry barriers and pricing power are low for some players, such as brokers. For them, competition becomes intense. Pricing gets compressed and valuation tends to stay lower. Entry barriers are high for exchanges and depositories. The business becomes closer to market infrastructure. It's hard to replicate, hard to displace, and that naturally supports premium valuation. Lower barriers and weaker pricing power usually mean a lower multiple. Higher barriers and strong moats support a valuation premium. And that's the full picture of the capital markets ecosystem. Who earns what and what really drives the business model. If you found this useful, hit like, subscribe to the channel and share it with someone tracking this space. And if there is any other sector you want us to break down next, drop it in the comments. Thanks for watching. See you in the next one.